This is Optimal Finance Daily, episode 1429, Why I Panicked When the Stock Market Dropped, by ESI of ESI Money.com. And I'm your host and personal finance enthusiast, Diana Merriam. This is the show where I narrate posts from a wide variety of personal finance blogs. We cover so much on this show, from saving to investing to debt reduction and more. So thank you for joining me today and every day. Are you loving Optimal Finance Daily? Why not share with a friend today? Invite them to join the party by sending them a link to oldpodcast.com. And while they're there, they can check out our 5 other shows on topics like personal development, health, and relationships. But for now, let's get right to it and continue optimizing your life. Why I Panicked When the Stock Market Dropped, by ESI of ESImoney.com. I have seen numerous articles on the recent stock market decline. The news media is in a frenzy, claiming the end of the world is near and that we're all going to lose everything by the time it's over. It's what much of the media does best: take an issue and sensationalize it to the point of terror, or at least that's what they like to do. As you've probably guessed, I'm not a fan of theirs. 2008. I have a pretty steady hand when it comes to stock market declines. I rode out the collapse of 2008, investing cash into stocks all the way down. I must admit that it was a pretty wild ride, and even I questioned myself many times, wondering whether I was doing the right thing or not, buying when everyone else was selling. It was worsened by the fact that even when I thought the market could go no lower, it often did. But this ended up being a great move for me. Over the next several years, those investments skyrocketed and have done quite well. If you believe in the overall worth of US stocks, which I do, why panic when they drop a bit? My panic. This time was a bit different for me though. It wasn't because my portfolio was down big time and my net worth had taken a huge hit, both which were true. That's what most people are afraid of, spurred by the media. But not me. I was panicked for an entirely different reason. My problem was that I didn't have any cash in my brokerage account. How can I buy when prices are falling, something I love to do, when I didn't have cash? Ugh. So I had to move money from a savings account to my checking account to Vanguard. Then it could be invested. But those moves took days, and I was panicked that I would miss my buying opportunity. I did get some money to Vanguard and bought more of my favorite index fund. But as the market has started to go down more, I'm moving more money there as I write this. I hope I get it there in time to invest. Good thoughts. This whole set of issues, like what do I do and where is the market going, was put into great perspective by a couple pieces I read recently. They are certainly worth sharing with you all. Let's start with these quotes from The Simple Dollar. Quote, "The truth is that I see these kinds of short downturns as an opportunity. Right now, I can buy a share of Vanguard Total Stock Market Index for 9% less than what I would have paid for it 3 weeks ago. Since my focus isn't on the return I'll get this year or next year or even 10 years from now, all that I can really be confident about is the price at which I'm buying right now." To sum it up, for most people who aren't on Wall Street or involved in day trading, the stock market should be a long-term investment, period. End quote. My thoughts. I see downturns as a buying opportunity as well. My focus isn't what happens in the next few years either, though perhaps it is within the next 10 years. I will need to adjust my investments in a few years or so as I glide into my financial freedom plan. The stock market is a long-term investment. It goes up and it goes down on a day-in, day-out basis. Over the long term, it goes up more than it goes down, but it's not a straight uphill climb, never has been. The other set of thoughts comes from Jonathan Clements. Quote, "Currently, the S&P 500's Shiller price-to-expense ratio is at 23.6 versus a 50-year average of 19.7. What would it take to get back to average historical valuations? We need the S&P 500, which closed today at 1859, to fall to around 1550. That would put the index 17% below today's level and 27% below its May 2015 peak. I'm not predicting we'll get that sort of decline, but it does tell you that US stocks aren't exactly cheap. Let's start with the obvious. None of us has any control over the direction of stock prices or any real insight into where shares are headed next. The market will do as it pleases. My advice: calculate your current mix of stocks, bonds, cash investments, and alternative investments, and compare it to your target portfolio weights. If you discover you're taking more risks than you intended, this isn't a good time to be selling stocks. Still, you might take that step if you're truly uncomfortable with your portfolio's risk level. For the rest of us, this is a time to carry on as usual. If you regularly invest part of your paycheck in the stock market, you should keep making those investments and feel mildly pleased that you're buying at slightly lower prices. End quote. My thoughts. Though the market has gone down, it looks like it has more room to drop. Interesting. That said, no one knows what the market's going to do, especially the hyped up mainstream media. So stop listening to them. Carry on. Sounds like good advice. What I'm doing. I do make regular stock investments into my 401k that will buy at the lower prices, but I will be supplementing these a bit with cash I had on the sidelines. I won't get crazy though, as I do need to maintain my emergency fund. Plus, I'd like some available cash in case real estate drops again. I may want to pick up another rental or two. Also, it may be a good time to pick up some high-yielding dividend stocks. I probably would, but I haven't yet sorted out my strategy on that subject yet. You just listened to the post titled "Why I Panicked When the Stock Market Dropped" by ESI of ESImoney.com. It's great to hear the perspective of a more seasoned investor here, as this past March was my first experience of a noteworthy stock market crash. Sure, over the past 5 years that I've been seriously investing, there have been other dips, but I was blissfully unaware of them. I take the approach of not watching the roller coaster ride of the stock market, but March 2020 couldn't be ignored. While I didn't sell any stocks, I can see now that I could have handled this opportunity better. I definitely got scared, not so much about losing the money I already invested, but more so about putting more money in. When I invest, I do it for the long haul, and I felt the need to bump up my cash position just in case things got rocky with my employer. I did need to take a 10% salary reduction, and my employer stopped contributing to my 401k, which made me feel like my job was a bit unstable. So what I ended up doing is fully funding the 401k by August, but I held it in a cash position rather than investing it like the rest of my funds. I looked at this as a secondary emergency fund, but I would still get the tax benefit of the 401k should I lose my job before the end of the year. And because of the CARES Act, if I needed to access that money, I would be able to do so penalty-free and have 3 years to pay the taxes on it. It was probably overly cautious, and before the end of the year, I moved all of that money over to the low-fee index fund within my 401k where the rest of my money is held. But it just goes to show how fear can drive money decisions, even for someone like me who should know better. That should do it for today. Have a happy rest of your day, and I'll see you on the Sunday show tomorrow, where your optimal life awaits.